All right, one of the biggest movers in today's market is Coca-Cola, which has gained more than 1.5%. The stock is among the top 10 holdings of Yacktman Asset Management, whose two mutual funds rank in the top 2% or better for the past 5 years and top 4% year to date. Don Yacktman is the firm's president and chief investment officer. Morningstar has nominated him as one of the possible managers of the decade for domestic funds. He joins us now from Austin, Texas. Don, congratulations on the nomination. Thanks for joining us.
Thanks.
Let me ask you, first of all, about this market. I mean, you are now holding cash, and you did invest that when you saw the market tank at the beginning of last year. Do you have concerns that the market is now starting to get to fully valued?
Well, it's not the values that it was back in January and February, certainly. We don't have a lot of cash, but we have a little over, like 12% or something like that. I don't know the exact number. It's a residual, and we're just having more trouble finding bargains, but the market's risen a lot in the last, 8 or 9 months.
Hey, what about Coca-Cola, Don? We mentioned one of the biggest movers today is Coca-Cola. It's up about 1.5%. It's hitting a 52-week high. You like this company. You still like it at these levels?
It's one of our top 3-4 holdings, so sure.
What?
Yeah, it's about 80% of their earnings, by the way, come overseas. So,
right.
People tend to look at it and think in terms of domestic Coke, and that's not a big part of the story.
Well, but the story today, and why we're seeing the stock, pop up at 1.5%, is that Coke is apparently back on at the shelves at Costco. That a big development in your view? You're laughing.
Yeah. As I said recently in another interview, it's a yawn.
It's a yawn. Well, then are investors making a mistake in bidding the share price up in your view?
We just think in very long time frames. I mean, if we buy something, we think if the market closed down for 5 years, would we be happy with it? And that's just our time frame. So we just don't worry about those short-term moves.
On the other hand, Don, if you don't expect the stock to move anymore in the next 5 years, I mean, it was cheap when you bought it. Maybe it's at full value now. Do you then sell it and reinvest your money somewhere else that you think has better growth potential?
Yeah, think of Coke as being like a AAA bond, and we look at forward rates of return on a risk-adjusted basis. And for AAA bonds, Coke is still fine. It's just it's not. I mean, it's not as good a value as it was when it was down at 40. It ticked down that low, but it's still a good company. It still provides a decent return, and it still provides a very good relative return on a long-term basis.
And Don, that pretty much your feeling on a lot of your top 10 holdings. You do hold them for a long time. I think about things like PepsiCo, News Corp, Viacom, Procter & Gamble, Microsoft. I mean, that's kind of your thinking about all of these names, correct?
Yeah, I mean, we've really made kind of a double shift in the last 2 years. I mean, we're way ahead of where we were in 07, which is very unusual. Most mutual funds are below where they were. But one of the reasons for that is we had some cash, and we had a lot of these very high-quality companies going into the downturn. Then when the downturn came, we used our cash, and we shifted into businesses with more economic sensitivity to them and made a lot of money. I mean, things like Americredit and Liberty Media, which is QVC, or some of the banks, some of the media companies. I mean, we have 3 media companies we've bought in the last 12 months in pretty big positions: News Corp, Viacom, and now Comcast.
Let me ask you about Americredit, because that certainly catches my attention. I think you guys made a big addition when we last talked with you. I think it was back on November. It's a subprime used car lender. No worries, I should say, in this economic environment, and worries about the consumer, or you think they'll weather it?
Well, the stock has drifted lower and lower in our holdings, not because we've sold off, but we've just had a lot of cash addition. So in effect, from a backdoor standpoint, we've sold it. They have a book value of around $15 to $15.50, and so when it was down at 3, it was a giveaway. At this price, it's not a giveaway, but they're also making loans at very good spreads. They have some of the highest returns they've had in a long, long time, and other people have exited the business, leaving more for them. So their relative position in that industry has improved.
I want to get a take on your thoughts generally on the market. I mean, it looks like you've shifted back into the high-quality names in a defensive move. Is that the case? Do you think you need to be defensive going into 2010?
Well, we get there by looking at the bottom up. In other words, we look at individual rates of return, forward rates of return, and caches or residuals. So we don't get there by trying to look at the macro side. But I will say there is a central tendency for the Fed to fund Christmas and the holidays, and so rarely have you seen a bad market in December. January will tell the tale a lot more than December will.
All right, we'll certainly be watching. Hey, Don, great to have you back with us. Don Yacktman from Yacktman Asset Management. Have a great holiday.